Hey, it's Scott Garlis at Stansberry Research. I'm here at the 2019 Alliance Conference in Las Vegas. I'm here with Dr. Nouriel Roubini, Professor of Economics at New York University Stern School of Business and Chairman of Roubini Macro Associates. Dr. Roubini.
Pleasure.
Thank you. Pleasure's mine. So the first question, you mentioned the China-U.S. trade war could be what causes a U.S. recession. If that problem is resolved, do you think the U.S. could avoid recession?
Well, I don't think that it's likely that the problem is going to be fully resolved. A full deal between U.S. and China is highly unlikely, given that the two sides are too apart. A full-scale trade, currency, technology, and Cold War in the short term maybe is also unlikely. They want to find a compromise, but even in that compromise, the U.S. is going to then impose 15% tariffs on consumer goods. We know that capex, manufacturing, exports are down. The only thing is holding the economy is private consumption. And even a 15% tariff by mid-December on consumer goods is going to slow down the economy. Maybe not a recession, but it could lead to a subpar growth, closer to 1% rather than 2%. So I think the more likely deal that is a compromise essentially doesn't resolve the problem and makes the U.S. economy quite fragile.
So you think maybe a partial deal, or that's still up in the air too?
They might try to find a partial deal, but how will Trump sell it to his electorate? He cannot say it's a big win if it's just a bunch of soybeans and a little bit of intellectual property rights.
Yeah.
He can be attacked from the left by the Democrats saying, you got a lousy deal. The deal could fall apart before the election because the Chinese don't do what we want. So even a partial deal that is still fragile could also fall apart before the election. So I think the tension between U.S. and China on trade, on currency and technology, the broader geopolitical Cold War, is going to stay with us for the next few years. And they're going to get worse. The only issue is whether they occur slowly or more fast.
Interesting. How long do you think the consumer can go on supporting the U.S. economy?
Well, today, capex is down, residential investment is flat, net exports are worsening, government fiscal impulse is flat, if not negative, so the only thing is holding the economy from a recession is private consumption. Consumer confidence is becoming slightly more fragile. The labor market is still strong, but it's a lagging indicator. If the forward-looking indicators keep on going south, eventually with a lag, the lagging indicator like the labor market is going to soften up. And if by mid-December we're imposing 15% tariff on all Chinese exports, including all the Chinese goods that are exported to Walmart and to consumers, that's going to squeeze real disposable income and is going to lead to a slowdown of consumption growth. So the only way to avoid it is just to find a deal with China so that you don't have the raise on tariffs on consumer goods. But I think that those tariffs are going to go higher.
Yeah, I feel like when we saw the meltdown in 2008 and 2009, once consumer confidence really started to go, things got ugly fast.
Yeah.
And that would probably happen that way again if consumer confidence falls apart, no?
Yes, consumption in the U.S. is about 2/3 of aggregate demand. It's key for the economy. The other components of aggregate demand are already falling. Therefore, that's the key. What I'm saying is that, either a U.S.-China trade war or a spike in oil prices because of a tension in the Middle East, those things are going to squeeze disposable income of the consumer, rise in import prices for oil or for Chinese goods, and that's going to be the tipping point for the U.S. consumer.
Yep.
And consumer confidence is becoming slightly more fragile already today.
Yeah, yep, agreed. You said a hard Brexit would lead to European recession. Could the UK and Europe avoid recession if we were to see a soft Brexit?
If there is a soft Brexit, probably avoid a recession. Even with soft Brexit, potential growth in the UK, there used to be 2%, is closer to 1.5%, so the economy is going to be in a more mediocre because even a soft Brexit implies restriction to trade, especially in the financial sector. The European economy is borderline in a stall, like in the United States, manufacturing, exports, capex are down. Germany is in a recession, Italy is in a recession. So there is already fragility. So a hard Brexit definitely tips the European economy in recession. If it's soft Brexit, it's going to be malaise, it's going to be stagnating growth, subpar growth, but maybe we avoid a full-scale European recession.
And then protection premiums have increased of late. Do you think the markets are pricing in the lack of a China-U.S. deal or trade negotiations completely falling apart?
The markets, in my view, are pricing in two things. One, that maybe there is going to be a deal. There's not going to be a full-scale trade war. And two, the fact that the Fed has to react to this trade risk by cutting rates. They're already done in July, September. I think highly likely they're going to cut rates in October. The question is whether they're going to cut rates in December. I think the White House wants to keep on cutting rates, the Fed to do so. They might play a trick of pretending there is not a deal with China so that by December 10, the Fed cuts another 25 basis points, and maybe they reach a deal by the end of the year. If that were to happen, you have 100 basis points of rate cuts into the election, because at that point the Fed cannot undo those cuts in an election year. You'll have a boost to consumer and business confidence, and that helps Trump with the election. So maybe that's the trick he's trying to play.
Yeah, and that would completely undo all the rate hikes last year, too.
Yeah, it will. It will. The question mark of whether cutting rates so much is the right thing to do or not, because the U.S. economy is weak, but there's a self-inflicted damage coming from a trade and a tech war. But the Fed has to react to that shock by easing rates.
Yep. And then lastly, do you think a fiscal and monetary policy response to the current slowdown is a correct one?
It's the correct response in the short run, but if we're going to have permanent supply shocks like trade with China or hard Brexit or an oil shock, those are supply shocks that reduce growth but increase inflation. And if you monetize them and you finance them with fiscal stimulus, eventually, like in the 70s, you get high inflation, accumulation of deficit, and that becomes unsustainable. Monetary policy cannot undo the effects of a permanent negative supply shock. If you have hard Brexit, growth is lower. If you have a trade war between US and China, you have decoupling, deglobalization, fragmentation, balkanization of the global economy with lower growth. If you try to stimulate growth above that potential is lower, then you cause inflation. If you do fiscal policy stimulus, eventually the debt and deficit is already high, becoming unsustainable. So the short-term response is to ease, but in the medium long term, both fiscal and monetary policy should not accommodate a permanent negative supply shock.
Very interesting stuff. Thank you very much for your time, sir.
Great pleasure. Good talking.
Certainly. Thanks for watching, and stay tuned for more updates.